Compounding your positions as a trader, in my opinion, is so powerful and so underrated. There's not a lot of traders that use it, but in my opinion, when you are trading in a profitable trade and once you tighten your stop loss, or once the price section and market structure ranges and liquidity provide you with brand new triggers for brand new trades, even though you are already running a trade, you should never ever slip the opportunity to enter another trade on the exact same pair, because 9 out of 10 times, if your bias and thesis get respected in the first part of the trade, they also get respected in the final part of the trade, and that is usually where the most amount of gains are to be made, and it's something that not a lot of traders do. But guys, it is no coincidence, as you can see on the screen right here, that Albert Einstein said compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. Obviously, compounding your positions is slightly different than compound interest, but it also isn't. Compounding your positions as a trader is the most powerful way to scale up your profits, and in today's video I will be providing you guys with exact calculations, exact proof why that it actually is. And guys, over here I have a real-time example of 4 different long positions that I'm currently holding on Near Protocol. So the first position was this blue one over here. This is my original position. I have a chart, I have my trigger. I'm looking at the deviation of this range. We have a beautiful range pivot 1, range pivot 2, and range pivot 3. We deviate beneath the range low. We know that after a deviation beneath the range low, if you have a nice inducement above the range low, we can enter a trade up on the perfect retest on the range low level, which is exactly what I did. Okay, first target was over here, second take profit target over here, third one and fourth one. Now this is my original position, so I enter up on the retest of the range low, invalidation beneath this low, and I have my target. Now if I would just play this original position right here, guys, towards my final take profit target over here, because with my original position I would only have 3 take profit targets, towards my first take profit target, which was over here, I would have had an RR of 2.13, towards the second take profit target an RR of 3.2, and the third take profit target I would have had an RR of 4.65. Now let's say I would risk 1% on this trade and I would take partials along the way. In the end of this video, in a little bit I will show you the exact calculations, but let's say we would gain about 2R in total, 2.5R in total after partial take profits, right, with this original position. Now once I saw that the range low was getting respected so well, and that we were seeing a strong bounce towards the mid-range, my conviction of an eventual move towards the range high liquidity pool becomes pretty strong, which means that in this case, at first I tightened my stop loss to this low over here, because if price was truly bullish after this bounce, in my opinion it shouldn't make a fresh low over here. So we push up, we get a local break of structure over here, we have had that perfect retest of the range low. So what does price do? It provides us with a new invalidation, which is this low over here instead of this low over here. So let's say at first our risk on this position over here was 1%. Now I tighten my stop loss to this low over here. Now approximately our risk becomes 0.2%. But if my conviction, thesis and bias remains the same for a new yearly high for near, and if the chart is providing me with brand new triggers for near, it means that it would be a shame to not use that spare 0.8R that I have left right now, since we went from 1R to 0.2R risk, to not reinvest back that risk into the position up on a pullback and make a lot more profits along the way up. So what did I do? The chart providing me with new triggers, I started looking for new execution. So I risk about 0.5R on this entry and about 0.3R on this entry. Now instead of locking in a total gain of 2.5R towards a final take profit target, if we would go from here towards that final take profit target, it would offer an extra RR of 2.1, and from the second entry an extra RR of 3.83. Now we are risking 0.5% on the first, 0.3% for example on the second add-on, and we take partials along the way. But let's say we gain an approximate 2R extra towards that final take profit target by adding these two positions. But understand that our risk remains the exact same, because if we now get stopped out at our new invalidation, we still only risk 1%, 1R of our account balance, right? And this way, by compounding your profits but keeping the risk the same, this is the most powerful way to scale your profits, guys. You can also do this by moving your stop loss to break even, but even more powerful would be to find a new invalidation for your position in profit. So you move your stop loss in profit, and let's say your stop loss in profit gets hit for about a 0.5R gain still. It means that once a chart provides you with a clean new trigger, you can add a brand new position with the same stop loss in profit, risking 0.5R. What happens next next is that if those positions get stopped out, you still don't lose. Because the original position would have been stopped out for a 0.5R gain on the account. And now you're risking 0.5R on a new position, which means that if both positions get stopped out, you gain and you lose 0R. And that is exactly the way you should do it. And the most made mistake by traders when they start doing this is that they become biased, right? So they constantly want to add to the position once their first entry gets hit and once they are in profit to compound. Because once I show you guys the calculations, you will notice how powerful this is. But what you want to do in order to be able to add brand new positions to your current position, you always want to start with a fresh chart. If I start right now with a fresh chart, I have a clean mind, clean picture, no bias, no thesis. I simply look at this chart and I try to identify, is this chart right now providing me with potential new triggers, potential new invalidations, and potential new targets, right? Maybe the chart right now is showing to me that I should really short near over here and target the range low liquidity pool. If that's the case, maybe I should close my long, right? But maybe the chart is going to be providing me with brand new triggers over here, which means that I have new triggers, which means that I have a new invalidation, which means that from the original positions over here, I can move the stop, right, to this new invalidation. Right now, the new stop loss is over here. But if the chart provides me with a new invalidation over here, I can tighten my stop loss and I can maybe even add a fifth position over here with that stop loss, with the same targets, as long as my risk management allows it. And this way, guys, if you guys start understanding how this works, you really are going to make a lot more profit. And in that case, your winners are going to hit big and your losers, they remain the exact same, because we are not going to tweak the risk management system. We're going to stick to the risk management of risking approximately 1 or 2%, but along the way up, as long as we can keep the risk the same, and as long as the chart provides us with brand new triggers and brand new invalidations, we can use this, compound our profits along the way up. Right now, let me show you guys the exact calculations that the difference on this near trade will make with these compounded positions. So over here, we have the original position calculation, risking 1%. First take profit target, locking in 0.53R. Second take profit target, 1.6R. And the third take profit target, 1.16R, right? Closing 25% at the first take profit target, 50% at the second, and 25% at the third. A total locked in gain of 3.29R, which is still pretty decent. But look at the difference it would have made if we would have used these compounded positions like I've showed you guys on the chart, like I've done on my own account and also on the challenge account. Original position, 3.29R locked in. First add on to the final take profit target with partials. I calculated it all, guys. You can calculate it after watching the video. 2.52R locked in, but we are risking 0.5%, so a total locked in R of 1.26. Second one, 1.12R locked in. Third one, 0.59R locked in, which means that at the end of the day, we have the original position, which still offers the same profits, but we have the 3 add-ons, which makes us locking in a total R of 6.23 compared to the original R of 3.29 towards the final take profit target. Guys, that is almost 2 times the gain that we would have made with the original position. And this should show you guys, this exact calculation should show you guys that by compounding your profits along the way up in long positions, or by compounding your profits along the way down in short positions, you are well on your way to Xing your profits as a trader. I hope you guys enjoyed today's YouTube video. If you guys did, make sure to smash up the like button, make sure to subscribe to our YouTube channel, and I'll catch you guys on Monday's video. Ciao, ciao.